Well, I'd say a couple things. I mean, the BLS number in December was more than weather. I mean, that was weather partially. There's a lot of other bizarre things going on that I don't think or reflect any kind of reality. I think the ADP number is closer to reality. I think that in January there were still weather effects, but much less so. I mean, it's hard to remember back, but that survey week, the week of January 12th, was actually a relatively warm, dry week. The rest of the month was a mess, but that week was warm. So I don't know that I don't think we got any weather bounce back in January. But I don't know that weather was playing as big a role in the month. The federal government is still shedding jobs, probably 3, 4, 5K per month, and I would expect that to continue throughout most of this year.
1,000 jobs economy per month?
It's better than that. It's a 3% economy, and it's 175 to 200K monthly payroll gain. I think the economy, nothing changed in December, January fundamentally. The economy is still improving.
Nice rally yesterday, but it was only about 25% of what we lost on Monday. So I'm not convinced the time is just right yet. The technical breakdown has been pretty strong, and I would like to see, as I'm sure you would, a two-handle, 200,000 or so on private payrolls, maybe get a good comment from the ECB tomorrow, follow that up. If we're able to get that with a good jobs report Friday, we may not get this elusive 10% correction just yet, but I've got to think, though, that the technical repair is going to take a while. Well, I'm glad you said portfolio, because that's something we really try to emphasize here at Wells Fargo. We want to make sure we're not positioning for the next trade. We're all about rebalancing and taking advantage of some weakness to add to positions where portfolios haven't participated. We still think the longer-term trend is favorable for profits, more historically average. Add profits, call it 6 or 7%, with an income opportunity on the equity market. We're looking at more historically average return opportunities.
Well, I think there's two things going on. There's an economy where they've firmly put deflation behind them, and I'm very confident that they're going to get about 20% EPS growth this year. For now, it's about 11 times price to earnings. So a very fundamentally decent looking market, but on the other hand, a very hairy market in terms of the volatility. And I think it's been exacerbated by external events. It's nothing to do with Japan internally, but it's the emerging markets contagion, which people have been buying yen, and that's pushed it back to 101 thereabouts. And so whenever the yen goes down, there seems to be an inverse correlation with the Nikkei. And just general risk aversion does take, this sort of hot money out of Japan. And I can't deny that there is hot money in Japan, but I still think that, if you can look out 6, 12 months, I feel it's the most conducive story in equities in Asia.